Valens Research, Uniform Financial Analytics.
Fiserv is one of those companies like Global Payments, et cetera. When we think about payment businesses, we think about Visa and MasterCard, who certainly own they own the networks, if you will, but they aren't the piping in the background in terms of that interconnects everything. That's these other companies that are in the payment processing business, like Fiserv. And Fiserv is interesting because Fiserv historically dealt with things like EFT and wire transfers, direct payments, all the things that kind of go on in the background for a bank for payments, but they were never really in the public eye. Then they bought a competitor, and that competitor that they bought was much more focused on being the credit card swipe machine that you use when you go to a grocery store or anything else in that business. So when they acquired that business, they really changed their dynamics. But what's interesting is you would look at the as-reported metrics for Fiserv, and you would think, you know what, Fiserv has been investing in its business even before the acquisition last year. And so, you know what, that's good because this business has been regularly growing. I don't have to worry about this being a one-and-done situation where they've invested once in growth and now they're basically stagnant. They've already been innovating. The reality is, when we look at the uniform accounting analysis, we see that they hadn't been steadily growing, right? They've actually been shrinking up until last year because of the fact that they were having problems finding new growth avenues for themselves outside of consolidating the space. And that changes how we think about market expectations. Because, right, on an as-reported basis, you would look at 3, 4, 10, and you'd say, okay, probably average growth on a normal basis for this company in terms of asset growth is around 6% a year. And if this company can grow at 6% a year, what's the market pricing the company to do going forward? Well, the market's pricing the company to have that 6% growth and for ROA to be stable to slightly down. But if we're really seeing a plateau shift because of the fact this company saw its profitability expand when it actually made the acquisition and a consolidated business, well, then it's potentially undervalued because if the market is expecting returns to be flat with steady growth. But what we know is outside of the acquisition of First Data, this company really isn't growing at all. And if it's not growing at all, and it's going to continue to, 0% asset growth, the market's already pricing in this plateau shift that the company's had to around 85 to 90%. It's already pricing it in. There's not as much upside as you might think there is for Fiserv if you were looking at the as-reported metrics, because you'd be misunderstanding how much this company can actually compound its business.
Valens Research, the world's leading source for uniform financial analytics.